They say that a promise is a debt. Yesterday, I showed you how to calculate the call option price using the Black Scholes model, and I promised you that next lesson I will show you how to calculate European put option or simply put option price using Black Scholes model. Now, this lesson I will use the same example that I used yesterday to show you how to calculate the put option price using the Black Scholes model. By the end of this lesson, we will have the question for today. And the question for today has been sent by Levi Lusaka from Nairobi, Kenya, who is a second year student studying Bachelor of Science in Economics. And the question will be, why is debt to GDP ratio of a major concern in a country? That will be the question for today, which is coming from Levi Lusaka, Nairobi student, who is taking Bachelor of Economics, Bachelor of Science Economics. I think second year student. That is what he said through the message that he sent to me. Now let's go straight away to our discussion. Now, because we are using the same example that we used yesterday, I just want to go through it briefly, and then we take our question for today. Now, this part we did yesterday, we discussed how to calculate the call option price using the Black Scholes model. And I think we said yesterday that Black Scholes model is a mathematical model used to determine the theoretical price of European style options. It's one of the most widely used model in finance, especially for pricing call and put options on stocks that don't pay dividends. We said a call means to buy, while a put means to sell. For European call option, we gave the formula yesterday, that is C, which is call option price is equals to S subscript, that is current stock price, times N D1. I showed you how to calculate D1 and how to read N D1 from the table. Then you minus K, which is the strike price of the option, times exponential function, which is always 2.71, raised to negative rate times time. Then you multiply by N D2. I showed you how to calculate D2 and how to read ND2 from the table. Now for European put option, which is the focus for our discussion today, the formula is here. P, which is put option price, is equals to K, that is the strike price of the option, times exponential function, or simply exponent, raised to negative risk-free interest rate times time to expiration, which is in terms of years. We multiply by ND2 minus current stock price times ND1. So we have to understand this formula first. Then we have given the meaning of each term which you find in these formulas. When you come across C means call options price, P means, now we didn't last lesson how to calculate call option price. We did that one yesterday. I'll still mention that example briefly before we move to the calculation of European put option. So C is a call option price, P is a put option price, S naught means current stock price, K is a strike price of the option, T is a time to expiration in years, R is a risk-free interest rate. Then this means volatility of the stock or the standard deviation of returns. Then NX, this X may mean D1 or D2. So it means cumulative distribution function of the standard normal distribution. This is a formula for calculating D1. We name D1. Now D1, how we calculate it, I showed you yesterday. You take the natural logarithm. This one means natural logarithm. Then S naught or S subscript means the current stock price divided by K. K is the strike price. Then work out this part first. Then you plus R, which is a risk-free interest rate. You plus volatility of the stock or the standard deviation of the returns squared divided by 2. Then you multiply by T, the time to expiration, divided by volatility of the stock, you multiply by the square root of time. Then the answer will be your D1. D2, you get D1, the one you have calculated above here, you minus the denominator. That is the volatility of the stock multiplied by the square root of T. So you'll be able to get D2. So for you to get D2, you must have calculated D1. So just take D1 minus the denominator here. That is the volatility of the stock multiplied by the square root of time to expiration. And you get your D2. Again, yesterday I gave you the difference between European call option and European put option. And we say the difference is that European call, as I have mentioned, call means to buy and put means to sell. So European call option gives the holder the right but not the obligation to buy an asset at a specified strike price on the expiration. You use a call option when you expect the price of the asset to go up. So if you are expecting the price of an asset to go up in the future, you are supposed to exercise the right today to buy. You buy that asset today, because if you wait, then you buy at a higher price, so you will be losing. So that is the call. That's the European call option. Then European put option gives the holder the right but not the obligation to sell an asset at a specified strike price on the expiration date. You can see it is the opposite of European call option, because here we are saying you want to sell today. So you use a put option when you expect the price of the asset to go down. Because if the prices come down in the future, it means you'll be selling at a loss. And therefore, you have to make the right decision as an investor. Now, that is something that we did yesterday. So understand this formula, how to get your D1 and how to get your D2, because this is something that we did yesterday. I just want to remind you. And if you do not have this video, you just look at our previous video that we did last lesson. Now, the next thing is if you go to the next page, you can see what we did yesterday. We did an example there. We are told to calculate the price of European call option with the following inputs. Current stock was 100 shillings, strike price shillings 105, time to expiration 1 year, then risk-free interest rate 5%, the same as 0.05, volatility 0.20 or 20%. So step one, you said you calculate D1, which is you input the natural logarithm in your calculator, then into brackets, S naught is 100 divided by K. K is 105. Work out that part first. You plus the risk-free interest rate, which is 5% or 0.05 plus volatility 20%, which is 0.2 squared over 2. You multiply by T. T is 1. That is time to expiration. Then you divide by 0.2 times square root of T, which is 1. Now, we rectified this part yesterday. So this is 0.2. So you are dividing by 0.2. So if you input, you just go to your calculator, you press that button written IN. This is natural logarithm. Then you put it to brackets, you substitute these numbers here. S naught is 100, K is 105. These numbers are given here. Then you plus rate 0.05, which is this figure here, plus 0.2, this one here, divided by 2. Then you multiply by time, which is 1, all over 0.2 times square root of 1. Again, this number is not 2, it's 0.2. You work out that, you get your D1 as 0.106. Now, once you get your D1 as 0.16, we said to get D2, you just take D2 is equals to D1, the 0.106, then you minus the denominator here, 0.2 times the square root of 1. If you work out 0.2 times the square root of 1, you just get 0.2. So to get D2, we have taken D1, which is 0.106 minus 0.2, the denominator here. Or just simply this part here, not 2 but 0.2. You get your D2 as negative 0.094. So once you get your D1 and D2, the next step is to find ND1 and ND2. I showed you how to use the table, the Z table, to obtain these numbers. You can even use your calculator if you are conversant with how to use a calculator. You can either use a standard normal table or the calculator. I showed you how to use the table to obtain ND2. So if you go to your table, you read 0.106, you find is 0.546. Then ND2, which is a negative 0.094, you get this number here. Once you get that, the last step is to plug into the call option formula. You know how the formula looks like. The call option formula, I showed you that formula here, so have in mind this formula here. The C is equals to S naught times ND2 minus K times E raised to negative RT times ND2. This is what I'm talking about here, this formula here. And we said if you replace or you plug in those numbers to replace what you have in our formula, C will be 100 times 0.542, because 100 is the S naught, the current stock price, times N D1 minus strike price is 105 times, now this part here we worked it out together and we got to 0.9512. That is exponential function, which is 2.71 raised to negative 0.05 times 1. We got this number here. We did that last lesson yesterday. Then C now will be 54.2. That is, if you work out this part here, that is current stock price you multiply by ND1, which is 0.542. Then you minus 105 times all this. You get your answer shillings 8.09. That is what we did yesterday. If you have a problem with calculating the price of a European call option, then you can look at our previous video. The purpose of our lesson today was to calculate, to show you, because that is what I promised you yesterday. I told you that I'll show you how to calculate the price of European put option using the Black Scholes model. So we will use the same example that we used yesterday, and you can see what we did here. So European put option. So remember, call option means to buy, but put means to sell. What are we supposed to do? So to calculate the price of European put option using the Black Scholes model, we use the Black Scholes formula for a put, which is derived from the call option formula using put-call parity. The Black Scholes formula for European put option is here, just as I've shown you from the previous page. You'll be taking P, you'll be saying P. Now P is price of the European put option is equals to K. K is a strike price times E, the exponential function, raised to negative rate times T. Then you multiply by ND2 minus current price of the underlying asset multiplied by ND1. Now this part here we have explained to you the meaning of each term used here. D1, you have to calculate D1 first. We have done that. We know how to calculate D1 because you're using the same example that we used to calculate European call option. We don't need to waste time calculating D1 again. You know what we did yesterday or the previous video. Then D2, the same concept. You can see you'll be taking D1, what you have calculated here, minus volatility times the square root of T. Now let's have the example. Calculate the price of European put option with the following inputs. We are using the same example that we used in the previous video. You can see the values are the same, only that we are not calculating the price of European call option in this question, but we are calculating European put option. So the first thing is to calculate D1 just as with the same way that we calculate the European call option. You calculate D1. D1 we got 0.106. Then calculate D2. D2 we got negative 0.094. Then the next step is to find ND1. To find ND1. Now ND1 and ND2 using standard normal distribution table. I showed you how to use a standard normal distribution table. You must have it. So if you go to your table and you read this number, ND1, that is negative 0. You can check the formula that, because in your formula, if you refer to your formula, you can see we are using negative here. You note what you are doing here. It's negative D2, and this is negative D1. So note those signs in our formula. Negative D2 and negative D1. So note those negatives in our formula. So when you come on this side, you'll be having your ND1 is negative. Your D1 will be negative. You not say 0.106, you say negative 0.106. So if you read from your table, you get your negative 0.106 is 0.4578. Then in negative D2, we got our D2 is 0.094 within that one, the previous calculation. Then is equals to, what you get is 0.5374. So what you do is that because this is a negative, it is a positive, you just take 1 minus 0.5374, and we got our ND2 is 0.4626. So we have gotten our ND1 as well as our ND2. The next step is to calculate the present value of strike price. Now in our formula, you have this part, so that requires you to calculate the present value of the strike price. Remember, the strike price is 105. So what you do is that you just take 105, you multiply by e, the exponential function. We say that is a 2.71 raised by negative 0.05 times t. T is 1. So this part, or this step, requires you to calculate the present value of strike price. So this is a formula for calculating the present value of the strike price. And you can see the strike price is 105 from our question. Just multiply by exponential function raised by r, negative r times t. You work out that, you get 99.88. Then after that, once you calculate the present value of the strike price, you plunk values into the put formula. That means you just pick, so our formula, remember, is for European put option, P is equals to K, that is strike price, times exponential function raised to negative r times t multiplied by ND2 minus S naught times ND1. So just a matter of substituting. This part, the present value of strike price we have calculated is 99.88, this one here. Then you just multiply by ND2. We got 0.4626, this one up here. Then we minus S naught. S naught is 100. You can look at from our question. Then you multiply by ND1, which is 0.4578. This is the ND1. You work out this part, you get 0.42. So the price of the European put option is approximately shillings 0.42. So that is how we calculate the value, the value of the put option using Black Scholes model. Now you can find some explanations here about how to use Z table or the standard normal table, which I showed you in the previous video. I think you are familiar with obtaining ND1 and ND2. You just use either the table or use scientific calculator. If you are conversant with your calculator, you can as well use it to calculate the ND1 and ND2. But the simplest way is using the Z table. I think the examiner will be providing you with the standard normal table where you'll be reading them, the figures directly. So that is the end of that. So as I promised you yesterday and told you that I will be showing you the next video how to calculate the European put option, using the Black Scholes model. Right, so that is the end of that discussion. Now, as we enter mentioned by the start of the discussion, that we end a question. We had a question, a general question, which is not to do with our discussion, but we have to answer the question. We have to answer the question, and the question was coming from. The question was coming from Levi Lusaka. Levi Lusaka from Nairobi is asking why is debt to GDP ratio of a major concern in a country. So first of all, we need to know what is debt to GDP ratio. Now, the meaning of debt to GDP ratio is the ratio of a country's accumulation of public or government debt measured in units of currency to its GDP. GDP means gross domestic product, and it has to be in percentage. So we take the total debts of a country, which can either be domestic or foreign debts. Then we divide by the gross domestic product. The gross domestic product means the total goods and services produced by a country within a particular period, mostly 1 year. So, if, for example, in Kenya, we take the total debts, which stands at 11.5 trillion, and then we divide by the total GDP. If I take an example for the year 2024, the GDP for Kenya was shillings 16.22 trillion. So if you take the total debts for Kenya, which is 11.5 trillion, divided by 16.22 trillion, you get 68.7%. So the 68.7% is the Kenya's debt to GDP ratio. Now, remember that all governments in the world, governments have only two sources of finance, that is either debt or tax. There are only two sources of finance for any government. Government can only get finance from either tax, that is taxing the citizens, or debts, either borrowing externally or domestically. So the recommended debt to GDP ratio by the World Bank is supposed to be 77%. So you may be asking whether the Kenya's debt to GDP ratio is within acceptable level. The answer is that the Kenya's debt to GDP ratio is within the acceptable level because it is 68.7%, and that recommended by the World Bank is 77%. So you can see we have not gone beyond the recommended ratio. If you compare Kenya's debt to GDP ratio with that of countries like Japan, for example, the debt to GDP ratio for Japan is 216%. That of Greece is 158%, which is the highest in European Union. That of Italy, 135%. That of United States of America is 100%. That of Portugal is 95%. That of China is 88%. So you can see, if you compare Kenya's debt to GDP ratio, which I've told you is at 68.7%, then we can say that the Kenya government's fiscal policies or maybe economic decisions are not prudent enough. So the government of Kenya is not reckless in making its decisions concerning its public debts, because you have to compare the debt that the country has with what the economy can generate. Since we are saying for you to calculate debt to GDP ratio, you take total debt divided by the GDP. You can see the GDP, the Kenya's GDP is 16.22 trillion. That is, the economy was able to generate or to produce goods and services worth 16.22 trillion. And out of that, our debt stands at 11 trillion. Remember, the 11 trillion, 53% is domestic, is borrowed domestically. That is around 6.2 trillion of these debts comes from domestic market. That is treasury bills, treasury bonds, pension funds, and from commercial banks like KCB, Equity Bank, Cooperative Bank. So when we talk of our debts being or at 11 trillion, this 11 trillion, all of it is not coming from foreign countries or lenders. Most of it, that is 53% or around 6 trillion, is borrowed domestically. The remaining 5 trillion, which is around 47%, is the one which is external debts. So the ratios are very important, because the higher the ratio, the higher the risk of default. So if our debt to GDP ratio, for example, is very high, like the one for Japan at 216%, then there is a risk of default. And this may cause a panic in both domestic and international markets. So I think that is the question that was coming from Levi Lusaka, who was asking, why is debt to GDP ratio of a major concern in a country? So it is of major concern because of the explanation that I have just given. Remember that to calculate the debt to GDP ratio, you just take the total debt for a country, that is both domestic debts and foreign debts, the total, divided by the GDP, the gross domestic product, and you multiply by 100. You see, you divide by the GDP because GDP is what the country is producing. So if it is producing very little, then you'll not be able to pay the debt. And that's why the GDP is very, very critical when we want to assess the ability of a country to pay its debts. Now, you may realize or you may remember that during the 2019 COVID-19, most of the countries in the world, the debt to GDP ratio went up drastically. The reason is because the GDP, the production of goods and services for most of the countries are reduced significantly, but the debts remain the same. So the debt to GDP ratio for most of the countries all over the world went up drastically. So that is the answer for that particular question, which was coming from Levi Lusaka from Nairobi, who said that he is a second year student taking a Bachelor of Science in Economics. So the question for today was that if you have any question, then you can send to our number here, just a general question about finance, economics, and government matters, and that is plus 254 727 87 1093. You can like our video, you can subscribe to your YouTube channel, and you can make a comment concerning our lessons. So next time we move to something else different, but you still continue being updated with our discussions. So we can have the next lesson maybe tomorrow or the day after tomorrow. And I think we have explained that portion that we had not discussed yesterday concerning how to calculate the price of the European put option using the Black Scholes model. So you can meet again. My name is Mr. William.